Operating assets are non-current assets used to produce revenue. They are often reported as property, plant, and equipment. The acronym is PP&E. The costs used to record operating assets includes purchase price in addition to all costs to bring to condition and location. Condition means installation and testing, and location means delivery. There are two categories of property, plant, and equipment. Tangible assets, meaning those assets that have physical substance that you can touch, and intangible assets, those assets that do not have physical substance, but consist of contractual rights, government rights, or rights purchased, sold, or licensed. You'll recall from Accounting 350, these costs are allocated as expenses to the accounting periods that they help to produce revenue. Tangible assets are expensed as depletion and depreciation, and intangible assets are expensed through amortization. The most common examples of tangible assets are equipment, buildings, and land improvements. Examples of land improvements are fences, driveways, landscaping, and other improvements to the land. Land is not depreciable because the useful life cannot be estimated. Instead of expensing land, it is capitalized, which means that the cost becomes an asset and continues to be reported as an asset. As a result, when a building is purchased, the cost must be allocated between the land and the building because one is depreciable and the other is not. There are a number of examples of tangible assets that are amortized. The first one is copyrights. Copyrights are legal rights that protect literary or artistic works. The legal life of a copyright for individuals is the life of the creator plus 70 years. For a corporation, it is 90 years from publication and 120 years from creation. A trademark protects a symbol or emblem. A trade name is similar to a trademark except that it protects a name, word, or phrase. For either, the legal life is 20 years with renewable 10-year periods, which means that the life is indefinite. An example would be the golden arches of McDonald's. A patent protects a product or a process to make a product. A patent has a legal life of 20 years. These are the most common ones. The list is actually much longer, with such intangibles as franchise agreements, customer lists, licensing agreements, permits, order backlogs, and employment contracts. The final PP&E are natural resources. These are assets in which resources are extracted. Examples are oil and gas deposits, mineral deposits, and timber. Once these resources are extracted, they become inventory. For example, minerals are mined to be processed and sold to customers. Therefore, the cost of the natural resource is allocated and expensed as depletion over the future periods. The costs will help to produce revenue. As a result, depletion is also added to inventory. Let's spend some time looking at intangible assets. Intangible assets can be separated into two categories. The first is externally purchased intangible assets. Likewise, this can be separated further into identifiable and unidentifiable. Identifiable intangible assets consist of those with a finite life and indefinite life. Finite life intangibles were identified earlier. They are capitalized and then amortized over their useful life or legal life, whichever is shorter. Identifiable life intangibles are capitalized but not amortized because the life of the intangible is unknown. Instead, these assets remain an asset and are tested for impairment. Impairment will be discussed in the next chapter. An unidentifiable intangible is goodwill. Goodwill is created only when one company purchases another company, and that means the entire company, including all subsidiaries. This is called a business combination. Look at this example. Goodwill is the excess of the $8 million purchase price over the $7 million fair value of Beta's net assets. Net assets are equal to total assets minus total liabilities. Goodwill is also capitalized and reviewed for impairment. Internally developed intangibles are also separated into identifiable and unidentifiable, and further into finite and indefinite life intangibles. Finite life internally developed intangibles are capitalized and amortized. However, the only costs that are permitted to be capitalized are legal fees, filing fees, and costs to litigate over copyrights, patents, and trademarks. Indefinite life internally developed intangibles are capitalized and reviewed for impairment. However, these costs are also limited. The costs incurred from internally developed intangibles that are not capitalized and amortized are classified as research and development. The general rule is to expense all R&D costs. We'll better define R&D in the next slide and look at some exceptions to this general rule. Examples of unidentifiable intangibles are costs incurred to train employees and costs to ensure the highest product quality. These costs benefit future periods, but we don't know for how long. Therefore, these costs are also expensed. Let's take a closer look at research and development. Research is the discovery of new knowledge, and development is translating this knowledge. As previously described, the general rule is that R&D is expensed subject to the following exceptions. Capitalize the cost of assets that have an alternative use. For example, a whatchamacallit is being used to develop a new pharmaceutical process. When the project is completed, if the whatchamacallit can be used for future projects, the cost is capitalized and allocated as depreciation to each of the projects. If the whatchamacallit can't be used again, then the cost is depreciated over the time the project is being developed. Drilling for oil and gas can be accounted for using either the successful efforts method or the full cost method. Full cost requires all costs to be capitalized and amortized, while successful efforts allows only costs for successful wells to be capitalized. Dry wells must be expensed in the current year. For software R&D or developed technology, all costs are expensed until reaching technological feasibility, after which time all costs are capitalized and amortized. Technological feasibility means the software has reached the development stage in which a working model or program design of the software has been created. In-process R&D is another exception. If Alpha purchases Beta, Beta might have R&D that it would have expensed if it hadn't been purchased. However, Alpha must do the following with the R&D. First, capitalize the R&D at its fair value as an indefinite life intangible and test for impairment. Second, if the project that is being researched or developed is successfully completed for sale to the consumer, Alpha should amortize the R&D over the period benefited. If not successfully completed, the R&D is immediately expensed. The next subject we will look at is natural resources. There are four major costs related to natural resources. The first is acquisition costs. This is the price paid to obtain the right to search. In other words, the cost to purchase, lease, or obtain a permit for a specific location. Exploration costs are incurred to find the natural resource, such as the cost of geologists and engineers. Development costs are those incurred to extract the resource. Finally, some companies might incur restoration costs, which are called asset retirement obligations. The next slide examines AROs in detail. An asset retirement obligation is a legal obligation to restore the property or environment to its original condition. This obligation is either a contractual commitment or the result of government regulation. Let's look at an example of an ARO. Alpha purchases a copper mine for $500,000 and is required to restore the property to its original condition in 5 years. We'll assume an interest rate of 10%. The copper mine is recorded as an operating asset. There are other account names that could be used. The ARO must also be recorded at its fair value, which we will estimate by using present value, 5 periods, 10%, Table 2. The ARO of $31,045 is a liability. This amount is also capitalized as part of the cost of the mine. Straight line depletion is taken on the total cost of $531,045 and added to the cost of the copper inventory. The difference between the $50,000 future value of the ARO and the $31,045 present value is future interest expense that must be amortized over 5 years. This amortized interest is called accretion expense. The $3,105 amortization in year 1 will be added to the $31,045 ARO next year to compute the accretion expense in year 2. Remember, we keep adding the amount amortized to the present value until it reaches the future value of $50,000. At the end of the 5th year, when the obligation is satisfied, Alpha records the following journal entry. You'll recall from Accounting 350, concept statement number 7 of the conceptual framework provides a framework for using expected future cash flows and present values as a basis for measurements such as fair value. In concept statement number 7, 2 approaches are described. The first is the traditional approach. With this approach, we use one expected future cash flow and an interest rate that is high enough to adjust for any risk or uncertainty about the estimate. Look at the following example. Alpha has published a book and is estimated to receive royalties from the publisher of $500 at the end of each year for 10 years. Alpha would like to purchase the rights to receive the royalties. Due to the uncertainty and risk involved, Beta estimates the fair value of the royalties using a risk-adjusted interest rate of 10%. The risk or uncertainty is whether the royalties will be $500 each year for the next 10 years. Therefore, a higher interest rate is used to compute the present value. Using Table 4, 10 periods, and 10% interest, we estimate that the amount Beta should be willing to pay for the rights to these royalties is $3,072. This is the approach that we previously used in the ARO example. We did so to simplify that example. However, accounting standards requires the approach explained in the next slide to be used for an ARO. The recommended approach to use to estimate fair value when uncertainty exists about future cash flows is the expected cash flow approach. This approach uses probabilities for a range of future cash flows with a risk-free interest rate. Such an interest rate will be much lower than a risk-adjusted interest rate. Returning to our example, we'll assume that we can use a risk-free interest rate of 6%. We'll also assume that there are 2 probabilities with different amounts of royalties to be received each year over different periods of time. Note that no matter how many probabilities there might be, they always add up to 100%. Using Table 4, 6%, and 8 periods for the first probability, and 6 periods for the second, we multiply the present value by each probability. As a result, Beta should be willing to pay $2,810 for the rights to these royalties. In an earlier slide, we looked at goodwill and the requirement that one company purchase another. But how do we account for the purchase if the entire company is not acquired? In that case, only individual assets have been purchased. This is often referred to as a basket purchase and applies to any purchase of a group of assets for one price. The issue becomes, how do we record each individual asset? The purchase price is allocated to each asset on the basis of its relative fair value. In the following example, $900 was paid for 3 assets. Alpha should divide the fair value of each asset by the total fair value of the basket, and then multiply each by the $900 purchase price. And that's all there is to it. Let's return to the subject of goodwill and examine in greater detail how it is computed. We have already defined goodwill as the purchase price paid for a company in excess of the fair value of that company's net assets. This differs from a basket purchase in that the assets are not recorded in proportion to their fair value. Instead, the net assets are recorded at their fair value, and whatever is paid in excess of this fair value is recognized as goodwill. We'll look at an example in the next 2 slides. Remember that goodwill can only be recorded when another company is acquired. Goodwill is not expense unless it becomes impaired. Sometimes a company can be purchased for less than the fair value of its net assets when the company is having financial or operating difficulties. Such companies are worth less than their net assets. This is called negative goodwill and is reported as a gain. Let's look at the following example. Alpha purchases Beta for $500,000. This begins the very long process of estimating the fair value of Beta's net assets. We'll assume that the book value and fair value for liabilities are the same. Let's examine 2 of the assets for clarification. Notice the value of the inventory. The explanation might be that Beta used LIFO and had very old layers of costs, whereas the physical items are listed at their current fair value. Also notice that the asset patent isn't reported on Beta's balance sheet. The explanation is that this patent was internally developed by Beta and any minor legal fees have been amortized. Therefore, there was nothing to report on the balance sheet. However, when Beta is sold, the patent becomes externally purchased and therefore is recorded at its fair value. In the future, this patent will be amortized. The total fair value of Beta's net assets is $478,000, which is less than the purchase price. Therefore, the amount of goodwill is $22,000. Once the fair value of Beta's net assets have been estimated, they need to be recorded on Alpha's books. The following journal entry would be recorded by Alpha. The next subject we will examine is a review of non-interest-bearing notes and imputed interest. This time, we will look at interest from the liability side for purchases of assets in which payments are deferred for a long period of time. In our example, land is purchased by issuing a $100,000 non-interest-bearing note. Interest is imputed at 10%. You'll recall that we used Table 2 to compute the present value, which estimates the fair value of the land. The difference between the $100,000 note and the amount recorded for the land is the future interest expense. The discount is a contra account to notes payable. The amortization of a discount for year 1 is computed the same as we did in a prior chapter. For year 2, we add the $7,513 to the $7,500 $1,131 to find the new net present value of $82,644, and then again multiply by 10%. The final subject of this chapter is self-constructed assets and the capitalization of interest. If a contractor submits a bid to obtain a construction contract with a potential customer, the contractor will include all estimated costs that are expected to be incurred. If the contractor will need financing to complete the contract, one of the costs that will be included in the bid is interest expected to be paid on any loans obtained. For interest, the FASB concluded that it shouldn't matter if the construction is performed for a customer or a company does its own construction without a contract. For example, a company might do its own construction to add a wing to its office building. In all cases, interest should be included in the cost of the construction. In other words, interest should be capitalized as part of the cost of the asset and not expensed in the current year. This is actually advantageous to the company because rather than expensing interest, it becomes part of the cost of the asset and is not expensed until the asset is depreciated. A discrete project means that there is a beginning and an end, and that the project is separate from any other. Only avoidable interest can be capitalized. Avoidable interest can be defined three ways. First, if the project did not exist, a construction loan would not have been made and interest could have been avoided. Second, if the project did not exist, another loan could have been paid off to avoid that interest. And third, if the project did not exist, it would not have been necessary to obtain a loan for other needs, and that interest could have been avoided. Let's look at an example of each of these definitions for a construction project that costs $700. There is avoidable interest if a loan of $700 is made to finance the project. There is avoidable interest if you already have a loan for $500, but instead of using your existing cash of $700 to pay off that loan, it is used to finance the project. There is avoidable interest if you use your existing cash of $700 to finance the project instead of using it for existing operating needs, and then later you obtain a loan for these operating needs. Interest cannot be capitalized for more than the amount of actual interest. To capitalize interest, the following criteria must be satisfied. Expenditures for the project are being made. Construction is in progress. In other words, the project is being actively worked on. This criterion is not satisfied by merely placing a fence around an empty lot and dropping some lumber on it. And interest costs are being incurred for any purpose. There are 5 steps for capitalizing interest. We'll list them and then look at an example. The first is to compute the average or weighted average accumulated expenditures. The second is to compute the weighted average interest rate. The third is to compute avoidable interest. The fourth is to compute actual interest. And the fifth is to capitalize the lower of actual interest or avoidable interest. Let's work through the following example. Make sure you understand the facts. Alpha begins construction on its own warehouse. The cost is estimated to be $1.4 million. A 9% loan for $500,000 is obtained to help finance the construction. There are also 2 other loans outstanding for other purposes that will be identified later in this example. In step 1, we compute the average or weighted average accumulated expenditures. To do this, we'll add the following new facts to the example. There are 3 expenditures made during the year, on February 1st, June 1st, and November 1st. To find the weighted average for these expenditures, we weight them by the number of months they were in existence. For the February expenditure, that would be 11 months. After weighting, we get a total of $525,000. An obvious question you might have is, why do we weight the expenditure and not use the entire expenditure? The reason is because we are going to compute interest that results from financing these expenditures. And interest is based on the part of the year that a loan is outstanding. In other words, if each expenditure required a separate loan to finance it, for what amount of time would we incur interest on the loan? Before we leave this slide, what if we only wanted to compute the average rather than the weighted average? To find a simple average, we add the beginning balance and the ending balance and then divide by 2. In this example, the expenditure's beginning balance is 0 and the ending balance is $1,020,000. When we divide by 2, we get $510,000. This is slightly less than the weighted average of $525,000. An average might be used when expenditures are made continuously throughout the year and it is not practical to weight the specific dates. You should remember the $510,000. We'll refer to it later in a future slide. Step 2 is to compute the weighted average interest rate. First, we begin with the construction loan at $500,000. If this had been the only loan, there would be no need to weight the interest rate. However, let's add more facts to the example and assume that Alpha has 2 additional loans for other purposes that are outstanding for the entire year, one at 7% and another at 10%. For these 2 loans, we need to compute a weighted average interest rate. To compute the weighted average, find the total interest for these 2 loans. Next, divide the $132,000 interest by the total principal of the loans to find the weighted average of 8.8%. Step 3 is to compute the avoidable interest. First, start with the weighted average accumulated expenditures of $525,000. The construction loan will finance $500,000 of these expenditures. What about the $25,000 excess? You'll recall from example 2 in slide 15 what constitutes avoidable interest. Therefore, we look to Alpha's other loans and use the 8.8% weighted average interest rate. Our total avoidable interest is $47,200. Before we move to the next slide, let's do some what-ifs. What if the weighted average accumulated expenditures had been $490,000? We would have multiplied $490,000 by 9% to compute the avoidable interest. And what if we had used the average expenditures of $510,000 instead of the weighted average of $525,000? The excess would have been $10,000 and the avoidable interest $45,880, not $47,200. Step 4 is to compute the actual interest. The actual interest is computed as follows. Step 5 is to capitalize the lower of actual interest or avoidable interest. Avoidable interest of $47,200 is less and therefore capitalized. The journal entries would be recorded as follows. The last 2 entries could be combined for a net of $129,800 debited to interest expense. Notice that the debits or the expenditures are to the account building. If the warehouse had been constructed for a customer, the debits would have been to construction in progress as an addition to inventory. Also notice that year 2 will begin with accumulated expenditures of $1,067,200 and be weighted for the entire 12 months. Additional expenditures in year 2 would be weighted and added to this total. Is it possible for actual interest to be less than the avoidable interest? The answer is yes. In our example, what if all 3 loans had been obtained on December 1st of the current year? Actual interest would have been only $14,750 for the month of December, and that would have been the only interest that could be capitalized. This final slide is a summary flowchart of the 5 steps we used to capitalize interest in our example. Take a moment to follow it through on your own. In the next chapter, exchanges of non-monetary assets will be covered in addition to other topics.